All right, there are just a couple of issues we need to discuss with notes receivable. The first is, how does a business actually get notes receivable in the first place? We don't normally act as a bank unless we are a bank, but if we're just a normal business, we are not in the business of loaning out money. So typically, we are not loaning someone money. Like in the last scenario, we said we loaned someone $1,000, and that's how we ended up with a note receivable. How it usually happens is we have a customer who is 5 months late on their payment, and we call them up and say, hey, you haven't paid us, please pay us. And they say, hey, I just need like 3 more months and I'll pay you interest. So can we just convert this from an account receivable to a note receivable? I'll sign on the dotted line, I'll sign an agreement to pay interest. So we say, sure. So we send the paperwork over, they sign it, and that's how we end up with a note receivable. Cash never actually changes hands. So what we're going to do in the journal entry, when we are converting an account receivable to a note receivable, we debit the note receivable because that is going up. We have more notes receivable, but we have fewer accounts receivable because we don't have that account receivable anymore, so we need to credit that. Again, we want to get in the habit of saying, whose is that account? So from here on out, we put a name after it. So we for Dave, we said, all right, Dave, your accounts receivable is now a note receivable. I am charging you interest. So supposedly, of course, in 90 days, we're hoping that Dave pays us. And if he does, this would be the journal entry. We get the $1,025 in cash. Again, this was assuming a 90-day note at 10% interest. We got $1,025 in cash, take the note receivable off the books, and record the interest revenue. So that's just like the last example we went through in the other video. This journal entry is just slightly different. There's no cash changing hands. We are just taking the account receivable off the books and adding a note receivable. All right, the other issue we have to talk about is dishonored notes. Honoring a note means our customer has paid it. Dishonoring it means they didn't pay it. So let's go back to the same scenario. 90 days comes and goes. Dave does not pay us. He has dishonored the note. Well, guess what? If someone dishonors the note, it's basically like the agreement is done. It's gone. We have to take the note receivable off the books. So we need to credit notes receivable because that note doesn't exist. It's been dishonored. It's gone. However, what's the next thing we're going to do? We are going to call up Dave and say, hey, you owe us money. Not only do you owe us the original $1,000, but you also owe us the extra $25 in interest. So Dave now owes us $1,025. This goes back to the more informal accounts receivable. Dave has not signed an agreement for this. So it goes back into accounts receivable, but at the higher amount. And the difference will now go in interest revenue, that $25. I want to point out here, we earned $25. We have basically loaned Dave $1,000 for 90 days. We earned the $25. There's no cash at this point, and so this kind of highlights the disconnect between revenue and cash collection. So revenue does not necessarily equal cash, and that is never more apparent than in this case with a dishonored note. We record $25 in interest revenue, even though we may never see that cash. All right, so those are the two last issues we needed to talk about with notes receivable. I encourage you to go back and do a lot of practice with notes receivable, especially with calculating interest.